there's a lot of rumor about the Fed coin and CBDC, central bank digital currency. There's also Bitcoin, with the US dollar being the reserve currency of the world, which caused America to boom, but it also caused many problems. And when we lose our reserve currency status, what happens after that?
The first thing people need to realize is the banks control the money, and more specifically, the banks outside of the United States.
Amen.
95% of the dollars in the world were created by lending them into existence. So most people have this idea that dollars are just kind of a green piece of paper, and you take your green pieces of paper that you digitally get with your paycheck and deposit it at the bank, and then the bank kind of puts that in a vault and stores it for you until you need it. But what they need to understand is, again, 95% of those dollars were not green pieces of paper. They were lent into existence by a bank, and therefore those dollars are a liability of a bank. The thing people should really be worried about as far as a central bank digital currency isn't necessarily a competing currency to the dollar. But what a CBDC really is, when you look at the mechanics and the financial plumbing, it's just the individual taking their account that they now have with Wells Fargo, that's a liability of Wells Fargo, and simply moving it to the Federal Reserve.
The big concern with Fed now, Fed coin, is that we lose privacy, that they'll track us. They'll track every move because they'll know everything we're spending money on, what we spend it on, who we give it to, and all this. I don't want them to know when I'm spending my money. It's none of their business. But now with, blockchain and all this, they can track anything they want. By now, everybody's heard of Silicon Valley Bank, SVB, and FTX, and all those other characters running around.
I just call it Stupid Valley Bank.
That's
the easiest way to remember it.
It's just foolish to me. I won't touch that stuff because it's all fake. So you save money and you put it in the bank, but your money is your asset, but it becomes the bank's liability. And what happened was, then the banks have to buy something. They have to buy something to cover the interest they're paying you here. And so they bought all these T-bills and this and that and all this crap. And then all of a sudden people realized the bank couldn't cover it all. And that's when the savers start running back to the bank, give me my savings back. And that was what the FDIC was for, to make sure that they would give you money back. But these banks had created so many fake assets out here, they couldn't cover it.
They've got at the most 200 billion, probably a lot less now with Silicon Valley Bank and Signature. But let's keep in mind, there's roughly $18 trillion in deposits in the United States. So that math doesn't work when the FDIC only has 200 billion. If we continue to see problems in the banking system that exceed the FDIC's ability to patch up the holes, then of course they come in on their white horse saying, well, we've got the solution. All you have to do is take your dollars from these unsafe commercial banks and just move them to the safest bank in the world, which is the Federal Reserve. And people see that as, oh, that little bit, that perceived security and safety, they give up their freedom. But what they don't realize is they're doing a deal with the devil. If we switch that chart of the inverted yield curve, and what we can see is the 2-year treasury yield is higher than the 10-year. So just right off the bat, if I ask you, Robert, if you're going to lend someone money for 30 years, are you going to charge them a higher or lower interest rate than if you lend them money for 3 weeks? The answer is going to be a lot higher interest rate because there's a lot more risk. So when we see the short-term interest rates higher than the long-term interest rates, that's the tsunami, the economic tsunami warning signal, saying, hey, something is really, really wrong. And most likely we're going to have a significant recession or depression in the near future. Now, what does that mean? How do you time this?
It's already hit. That was Silicon Valley Bank and Deutsche Bank and Credit Suisse. It's already hit.
Yeah, this is just the first cracks that you see in the system, but the dam hasn't yet broken.
Correct.
And so that's what the yield curve is telling us. So when the dam breaks, how do we time that? How do we know when that's going to happen? Assuming that Silicon Valley Bank is just the first crack. The whole global economy is very vulnerable. And this is what that yield curve is telling us. So what people really need to be cognizant of is when the 2-year yield goes back down below the 10-year, because when the yield curve is no longer inverted, that's when we usually get the recession or economic depression. And so right now, now, what the smart money is telling us through that curve is that we're most likely going to have that after the summer. We're going into the fall of 2023 or the winter, spring 2024.
Yeah, this is historically. So all people say, oh, good, the 2-year went down below the 10-year. Everybody thinks that's good news, but it's not good news for the average person.
Yeah, that means that the tsunami is not 100 miles away. That means that the tsunami is 100 feet away. So it's not there yet, but you're going to start seeing the cracks, such as Silicon Valley Bank, Signature, Credit Suisse. So now, as prudent investors, or just the average Joe and Jane trying to protect your financial security, you need to ask yourself, okay, what is the financial tsunami warning system telling me about what's going to happen over the rest of 2023? Or what other signals or warning red flags can I extract from it? The next thing that you need to look for is the curve no longer being inverted, which would mean the 2-year Treasury yield going back down below the 10-year. Because if you go back to 1950, you see that 9 times out of 10, that financial economic tsunami hits the shore after the curve is no longer inverted.
So let me ask this question. When somebody says the Fed pivots, does that have anything to do with the inversions and all this other stuff?
Absolutely it does. So right now the Fed is in a tightening cycle. So they're raising interest rates. So the Fed pivot refers to when the Fed starts actually lowering rates. And so usually when you see the curve, we'll call it uninvert, it's a result of the Fed actually dropping rates and dropping rates very, very quickly.
So people will celebrate, says, oh, the inflation's over, everything's happy days are here again. Is that what you're saying?
Exactly. You nailed it. And then the Fed's going to drop rates and they're going to say to themselves, oh, this is fantastic. The Fed came in, they saved the day. They're dropping rates back down to 0. We've got nothing to worry about. If we were going to have a recession, now we're not. And then that's when that wave is going to impact the shore. And for those people who aren't prepared, that's when they're going to get financially destroyed. I mean, how many people that when this curve has been inverted for probably 9 months, how many people in the mainstream media are saying, oh, don't even worry about, don't focus on it. The unemployment rate is low. The economy's on fire. Everything's fine. And it's just like those people that are in helo that aren't paying attention to the warning system saying, oh, Robert, you're just fear mongering. You're sitting there talking about a tsunami that's never going to hit. We're protected here until the thing actually hits and they get wiped out. When you're talking about that water going out and the people think that's free fish, that's the Fed dropping rates. Because when the Fed drops rates, most likely people are going to be, oh, great, that's free fish. I'm going to go buy stocks. I'm going to buy all these risk assets and get rich.
Yeah, I'm going to buy more real estate because the interest rates are down and they're going to rush back in and the free fish is going to kill them. So what advice would you have for people right now? How do you prepare for this giant tsunami? I think it's the biggest in the world because it's global.
And to think we've only hit the tip of the iceberg. And the reason I'm saying we've only hit the tip of the iceberg because after all these entities were bailed out, the yield curve is still sending us the exact same message saying, hey, you guys think the Fed solved the problem, but they didn't even understand the problem. So getting back to your original question, I can just tell people what I'm doing with my personal portfolio. And I'm not all in cash, but I have the biggest cash position that I've ever had. And I make sure that I've got, 10% physical gold. With the cash position, I'm currently in short term. That's very, very key. Short term treasuries, not in 10-year, not in 30-year, just 1 month, 3-month, very short term treasuries. Because those are a liability of the government. They're not a liability of a bank. And if you're worried about the banking system, that's that counterparty risk that I'm trying to avoid. We've talked about the bad news about money, but let's talk about some good news about money, is that for those who are paying attention, we have this warning system. And it's just like, the people that are paying attention to the tsunami, they have a warning system. And so they can just go ahead and take the advice. They can head for the hills. And then, after it hits, they can be in a good position, go back to the town and buy a lot of that oceanfront property, that real estate at a very, very low price. The larger the crisis, the larger the opportunity.